Cash flow to a business is what blood is to the body. Without any blood flow, the body is going to die, right? In business, without any cash flow, the business is going to die. So in today's video, we're going to learn what is cash flow in real estate, why is it important, and I'm going to give you a step-by-step tutorial on creating a very basic spreadsheet so that you can start getting comfortable and familiarizing yourself with cash flow modeling when it comes to rental property. Now, a very quick disclaimer. The bigger the deals, right, the more complicated these spreadsheets become. So we'll go down that route in a different video, but for today's video, it's gonna be very basic, okay? What is cash flow in real estate? Investotopia, right, defines it as the term cash flow refers to the net amount of cash and cash equivalents being transferred in and out of a company. Cash received represents inflows, while money spent represents outflows. So in simple terms, cash flow is basically the cash that is flowing in and out of a business. So now let's apply that to real estate. You buy a property and you decide to rent it out so that you can make some money, right? The rent you charge to your tenant is going to be the cash that is coming in, and the expenses to upkeep and maintain the property is going to be the cash flowing out. So doing some simple math, right? Cash in minus cash out equals your cash flow. And to keep things very simple, again, that's the purpose of the video, just remember PITI. These are going to be your common expenses, your principal and interest, your taxes, and your insurance. Depending on the property, there's going to be a little bit more expenses than that, but again, for the sake of the video, we're just going to keep it very simple. And while we build the spreadsheet later on in the video, you're going to see some of these more common expenses in play. So why is cash flow important? So going back to our statement earlier, for a business to be sustainable, it has to make money. After paying all the expenses, right, you're going to want some money left over. It doesn't make any sense to have a business that is not making any money after paying everything. The business is there to serve you, right, the business owner. And when you're buying rental property, you're basically purchasing another stream of income. The property is there to serve you. And if you understand cash flow and cash flow modeling, it's going to help you decide whether or not a property is worth the investment. Cash flow is also going to help you as the investor understand the value of the property, right? Because let's say the property is producing a certain amount of money, it's going to be valued at that. But if you're able to increase the income that it produces, you're going to increase the value. Now that we have a understanding of what cash flow is, let's get our hands dirty and let's create a spreadsheet. All right, as you can see, I have just opened a blank Google Sheets spreadsheet. And you can either use Google Sheets or you can also use Microsoft Excel. Either or is going to work. So let's get started. We can start with income. To that, we're going to write gross scheduled income. We're going to write other income. Then we're going to write total gross income. Okay, let's do this. Let's format this to accounting. I'm gonna bold this. So total, or the gross scheduled income, is going to be what you're renting the property for. So if you have 2 units at $900 each, it's going to be $1,800 per month, right? So it's what you're renting the units for. Other income is going to be other income that the property is producing. So let's say if you have a 4-unit structure, 60-unit structure, and you're charging extra for a parking spot, whether it's $50, $75, that's where you will put other income at. And another form of other income is going to be if you have coin laundry that's in the basement, and you collect those coins like every 3 months or every month, you're able to put that in other income as well. So let's do this. Total gross income is going to be those two. So let me do that. The next thing we're going to add is a vacancy. Well, let's put that up here. a vacancy factor. So the reason why we are adding vacancy, we're going to put it at 6%, is because let's say tenants decide to leave and you're going to put in new tenants, the property is going to be vacant, right? But if you have long-term tenants, it may not happen, but banks, whenever they're lending, depending on the market, they're always going to add a vacancy factor, right? Because it helps lower the amount of risk. And generally, depending on the bank and on the market, it could be like a 5, 4, or 6%. So we're just going to do 6%. So what we're going to do is that the total gross, right, times 6%. It's going to be at 0. And from there, we're going to do, I'm going to make it all capital. Total operating income. And it's going to equal this minus that. Let's do that. All right, up next is we're going to do expenses. I'm also going to bold that. Okay, what we are going to do is it's going to be taxes, insurance, repairs, / maintenance, management. If you have a property manager, those are going to be kind of the main ones that you're going to see. Let's just write other. Then we're going to write utilities. Did I spell that right? Utility. I think that's how you did I spell that right? I'm sorry. Utilities. Yes. Okay. Sorry about that. I'm also going to actually utilities. I'm sorry, it just looks really weird. Utility. Okay, whatever. Utilities is going to be electricity, gas, heat, water. Then we're going to write total operating expenses, which is going to be, let's do all these. Yep. Let's bold that. Let's bold that one. Okay, after that, as you can see, you're going to be like, where is the mortgage payment? So what we call that is debt service. We're going to add a 0 for there. Well, actually, hold on. I did forget one. We're going to put net operating income, otherwise known as what is the NOI. So if you're going to become an investor, you got to start getting used to these terms. Sum of total operating income minus total operating expenses. From there, we're going to add the debt. We're going to subtract the debt service from that. And then we are going to find the cash flow, which is going to be that net operating income minus the debt service. Okay, now we're going to run through a very, very easy and brief example. So for example, let's say you have the property rented at 1,700, right? Let's say you have no other income because you include the washer and dryer. You don't want to do any coin operated laundry, so you just leave it at that. So because I'm renting the property out at 1,700, there is no other income, right? We factor in the 6% of the vacancy for $102. So that means total operating income is going to be $1,598. So let me actually do that. Let's say the taxes on this property is going to be about $270 a month. Your insurance about $50 a month. Repairs and maintenance, you could do kind of like a 10% factor, right? Management, if someone is, managing your property, you can also have about a 10% charge. Now, this is where it's going to be really interesting because depending on the lease, you can push the utilities on the tenant. So if it's a single family house, generally all the utilities are going to be paid by the tenant. When you have a bigger building, again, it just depends on your business structure and the way that you want to structure the way that you want to do your leases, right? So let's say all the utilities are going to be on the tenant. So based on taxes, insurance, maintenance, and management, right, we're going to have about $600 and $660 per month. That gives me the operating income, right? After everything, after the operating income minus operating expenses is going to be $938. The debt service is then going to be what is your mortgage payment. So let's say my mortgage payment on this property is going to be about $580. That means every month I should be cash flowing about $358. So again, you want to be able to use this so that way you're able to understand, okay, is a property worth investing? Is it not? Do I want to have a property so that I can make $358 per month? Again, these are just so that you're doing your numbers. Once you actually operate the property, the numbers may change. Like you may not be spending $170 every single month on repairs and maintenance, right? Maybe some months it might be shorter, might be a little bit more. Or another thing that you can do is also do what we call capital expenditures, where you always put 10% in like a savings account just in case anything happens to the property, like a roof, a newer furnace, whatever it may be, right? You have that money set aside. So there you have it. This is a very simple and very easy way to figure out the cash flow on a property.